Hello and welcome back to another lesson. Today we will be going over what is a Japanese candlestick and the Japanese candlestick anatomy. Okay, first things first, we should know about the Japanese candlestick's origin. Japanese candlesticks was discovered by a Westerner named Stephen Nyssen. Back then, the Japanese created their own way of technical analysis to trade rice. Slowly, this technique grew into the 90s. And here below is an example of what Japanese candlesticks look like. You see that there is a body, or what they would say a real body. Now it doesn't really matter about the shading because we all know that we have traditionally red and green candlesticks, but back then it was also the colors of a hollow body or a white body and a filled body, which was black. But we have the wicks or the shadows above and below. And then we have the high and the close, which is at the high is at the top of the wick, and the close is at the bottom of the wick, aka the top of the body of the candle. Now, depending on what kind of trader you are, different various time frames will work better for you. Now, Japanese candlesticks can be used on any time frame depending on which type of trader you are. Either you're a scalper or a swing trader. These time frames consist of the 1 minute, the 5 minute, 15 minute, the 30 minute, the 1 hour, the 4 hour, the daily, and so on. Now, if you're a swing trader, you might want to rely on the daily, maybe even the weekly, and the lowest time frame, maybe the 4 hour, and then place your entries on maybe like the hour or so. Now, for scalpers, such as myself, we rely basically on maximum, maybe the 15-minute, and placing entries on the 5-minute or the 1 minute. Now, the candlesticks are used to describe the price action during whichever time frame you're using. Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. If the close is above the open, then a hollow candlestick, usually displayed as white or in other cases green, is drawn. If the close is below the open, then a filled candlestick, usually displayed as black or in other cases red, is drawn. The hollow or filled section of the candlestick is called the body. The thin lines poking above and below the body display the high and low range and are called shadows or wicks. The top of the upper shadow wick is the high. The bottom of the lower shadow wick is the low. Now let's get deeper into candlestick anatomy. Knowing the anatomy of a candlestick is very important. Candlesticks have different body sizes, and when it comes to forex trading, the bodies help say a lot. Long bodies indicate strong buying or selling. The longer the body is, the more intense the buying or selling pressure, further indicating who's in control, the buyers or the sellers. Short bodies indicate very little buying or selling activity. Now, in the trading language, buyers are bulls and sellers are bears. Below we have an example which is of the long and short of the bear and the bull candle. Long white or green candles show strong buying pressure. The longer the white or green candle is, the further the close is above the open. Now, the opposite implies just the same. The longer the black or red candlestick, the further the close is below the open. Now let's get into shadows, aka wicks. Some people call them shadows, most people call them wicks. But in this example, we're going to be using wicks. The upper and lower wicks provide important information / clues about the trading session and price action. Upper wicks signify the session high. Lower wicks signify the session's low. Candlesticks with long wicks show that the price action occurred well past the open and close. Candlesticks with short wicks indicate that most of the price action was confined near the open and close. If a candlestick has a longer upper wick and a short lower wick, this means the buyers drove price higher, but for some reason sellers came back in and drove price back down towards the end of the session to the opening price. If a candlestick has a long lower wick and short upper wick, this means that sellers flexed and forced the price lower, but buyers came in and drove the price back up towards the opening price.